Gilles Moec is co-chief European economist at Deutsche Bank. He joins me now. Very good to see you, Gilles. Now, I really liked some of your analysis coming out, a report, Bleak House, moving on to great expectations. There are a lot of expectations ahead of the summit this weekend. What really can we be looking out for, if anything at all?
I think we'll have something quite comprehensive, actually, because there's a sense of urgency now. And probably on a political point of view, what has changed in the last few weeks is that we have a feeling that Berlin has made up its mind on what it actually wanted from the rest of Europe and how it wanted to deal with the crisis. And that changes a little bit the dynamics. So we know the ingredients, okay? The ingredients that Greece to be sorted out in a more meaningful manner instead of basically simply allowing them to continue to muddle through. If we do this, we need to control the second round effect, so we need to recapitalize the banks. And three, if we do that, it means that we deplete the resources of the EFSF to continue to support Spain and Italy, so we need to find a way to enhance that. I think that on all these three ingredients, there's basic agreement. It's on the details that things continue to be quite complicated, but I don't feel a rift at the moment across the Europeans. It's a matter of finding the right solution. It's not a matter of determining what should be the global outcome of all that.
What's your reaction to this breaking news from the Troika? There is still significant concern about Greece, saying they need private sector involvement, and that is crucial. How will bond investors react to having to take greater haircuts? Can that be agreed this weekend?
Well, it's been brewing for a while. I don't think there's any surprise here. I think that what's happening right now is that it's all taking shape, maybe in a disorderly way, in this very messy European way. But it's taking shape in the sense that we know that there's a push to get into a bigger PSI. Everyone now is saying this, not just the German government, but also the French government has acknowledged this. So that the Troika comes out and basically gives a kind of economic justification to what was anyway brewing, I think that's normal. And to some extent, it reflects the fact that, probably with the exception of the ECB, which actually dissented in this Troika report, there's a better sense of convergence than what many people seem to be thinking at the moment.
But one of the main focal points has been the EFSF and how to leverage that, how to give it firepower. And that seems to be where the rift is developing, if there is one, between France and Germany. How can they overcome that? Does it need the massive injection that France is calling for?
First of all, I think we need to be cautious when toying with the numbers. I mean, it's become very popular to come up with 2 trillions, 3 trillions, you know, God knows what. We may not need that much money. I mean, the big issue at the moment is to have enough money in the EFSF to allow the banks in the struggling countries to be recapitalized if the market fails to do so, and basically continue to support Spain and Italy. If you take all this together, especially since it appears that the bank recap is probably going to be smaller than what was estimated, you probably need something like 800 billion euros, not 2, not 3 trillions. If you take Spain and Italy together, it's a matter of probably 700 billion euros to cover them for the next 3 years. We don't need that much money. But we still need to lever it up, that's clear. I know the word leveraging is not very popular at the moment in Berlin or in Brussels, or in Frankfurt for that matter. We need to find a way. There are basically two now popular solutions. The first, which seems to be favored by the French, is to turn the EFSF into a bank, which would actually involve the ECB. We actually advocated this solution a few weeks ago, but it seems that there's a lot of unease about this, both in Berlin and in Frankfurt. France seems to be at the moment the only one continuing to support this, or there is the solution of the insurance scheme. But again, what I would highlight is the fact that in both cases there is an agreement to actually enhance the firepower of the EFSF. It's not the situation in which we were 3 weeks ago, in which the basic line was we voted 440 billion euros from the AAA countries, and here we stop. Again, it's a rift on the technical solutions. It's not a rift on the principles.
So everyone knows it's going to be made bigger. Is that enough, though? If austerity packages aren't working in Greece, clearly they're not. 2030 is until we're going to see debt at a very high level. What is the outlook for Italy and Spain? Are they going to need yet even more money? Is 800 billion enough, do you think, if the austerity packages stall growth?
I guess that the case for Spain and Italy, and that's true for every sovereign at the moment, the ultimate solution lies in their hands. I mean, there is no amount of official support from the rest of the world that can actually save you from yourself. In the end, ultimately, it depends on the capacity of the governments to actually deliver. And on this, I think we've had some pretty good signals, actually, coming from a number of peripherals. In the case of Spain, we've had some progress towards fiscal adjustment. We've had progress towards also structural reforms. Italy actually is interesting because it was not a case of blatant fiscal mismanagement. Before the crisis actually extended to Italy, it's more a question of ensuring that the country has the kind of floor potential growth that allows its public debt to be sustainable. But it's not, again, a blatant case of mismanagement. It's about structural reforms. It's about the capacity to deliver. But at the moment, I don't see anyone in Europe basically, simply sitting on their hands and not doing their bit. We can discuss how efficient it is. We can consider that in Greece, for instance, there's a rift between what is agreed by the government and what is actually implemented in reality in concrete terms. But there is still, and I think it is really important, there is no real alternative at the moment. If you look at the political landscape in Europe at the moment, even in the peripheral countries, the electorate is actually shifting towards parties that advocate, in many cases, even a more stringent version of the adjustment.